Private credit powerhouse Golub Capital showing middle market private companies posting strong growth in the first 2 months of Q4, giving investors a glimpse of what could be ahead for public companies this earnings season. For more, Lawrence Golub joins us here on set. He is, of course, the CEO of Golub Capital, and more famously, Karen Feinerman's husband. Lawrence, it's always great to see you.
Thanks, Melissa. Very happy to be here. Congratulations on
Thank you.
The 18th.
18th, yeah. And 18 years ago, your company was also not public, along with Tesla and Snap and Meta.
Correct.
We neglected to put that out there.
We've had more steady earnings than they have, though.
Tell us about what the index has shown about what we can expect this earnings season.
So taking out of our portfolio actual results from real companies for October and November, 9th quarter in a row with solid revenue growth, 6th quarter in a row with margin expansion. Keep in mind these are U.S.-centric businesses, private equity backed, so not a complete reflection for international. But one of the things that stands out particularly is this is the 3rd quarter in a row of pretty good results from our consumer sector. And if you remember, starting about mid-23, consumer spending started getting really soft. Sticker shock from inflation, interest rates going up, reducing disposable income, burning off of excess savings from COVID stimulus. And folks, including in the private equity industry, were worried about how long that would continue. But, especially this quarter after 3 in a row, it really looks pretty strong. And outside of consumer sectors tied to the home cycle, it's really great.
When you start to look at what's happened in the last month and a half of the year, though, in terms of a rising dollar, rising rates, I'm just wondering when you expect things like that to start surfacing, if at all, in some of the results.
So one of the things that always strikes me when I come to visit you, which is not often enough, is the distinction between what's happening in terms of revenue and earnings growth, which is what we focus on, and valuations, which is a large part of what you focus on. The strong dollar in terms of the consumer is a plus. It's really not a minus. If a company's got big operations in Asia or Europe, the currency translation profits are not so great. But for the consumer, it's great. We've got low unemployment, high wage growth. We've got increases in job openings. The consumer is healthy and driving the economy right now, and the dollar doesn't matter much, except maybe to the extent energy prices are lower, which again is a tailwind for the consumer.
So thanks for being on, sweetie. Nice to have you. Do you think that this sounds inflationary?
Yes. So
how inflationary do you think it's going to be?
And do you address all questions at home with Sweetie?
Most depends on if he's in trouble or not.
Yeah.
So not often.
Notes from the doghouse.
Yes.
We're seeing, relative to Fed expectations, stronger inflationary pressures. Chris Waller came out with some thoughts on inflation still coming down. He and I are not seeing eye to eye on this. The Fed recently raised its inflation expectations for 25 to 2.5. I'll be surprised if it doesn't have a 3 handle, and I won't be surprised if it's 3.5%. A lot of the Fed measures are taking advantage of the gasoline price reduction. So gas prices in Q4 down about 35 cents a gallon on average. End of period gas prices down 50 cents. Maybe that'll continue. It's not the way I would bet. So we're expecting inflation in the 3s. And I think if you look at where the futures are on Fed funds versus where the Fed dot plot is, I think the futures are probably a little low, and they're way higher than the Fed dot plot.
Lawrence, 18 years ago, when we began the show, private credit as a product, as an investable product, was also not really around, at least in the way it is today. Talk about both the availability of access to private credit, what that's meant also for credit spreads. Currently, we're about as tight as we've been on high yield OAS since going on, not necessarily even what you're investing in, but if you look at credit spreads, they're at tights. They're at tights we really haven't seen since before the big crisis. Talk about the asset class as a place for investors to invest and the opportunity.
Sure. Well, I think when one is investing in private credit, particularly direct lending, which we specialize in, it's very hard to be a market timer. As a retail investor, you're going in and out of a BDC or some kind of fund where you have liquidity. Okay, you have the ability to pull the trigger and get in and get out. From our point of view, we make a loan, we get paid back 5 years later. Most of the big institutional investors and private investors have to be choosing the asset class and choosing a manager. There actually was in BDC land a couple of big public BDCs back 18 years ago. Neither one of them exists anymore. It was American Capital and Allied Capital. And they both blew up because of strategy shift. They were doing well in lending. They grew too fast to sustain the growth. They had to start buying companies. They didn't know how to own companies. I think every time there's been a cycle where fundraising is a little easier, many big investment managers, multi-strategy investment managers, public GPs, they raise money when they can, not necessarily because they should. In the middle market, the spreads are medium now, and we'll see what happens in terms of deal volume picking up. Private equity firms are very excited about deal volume picking up. They're way, way more excited about deregulation than they are worried about tariffs.